Since the war started, crypto, including Ethereum and Bitcoin, have been the best performing asset, dramatically outperforming gold. Then it's energy, and then tech. And tech outperforms because people, when they worry about growth, global growth, they buy growth stocks. So let's look at individual stock performance. Top 5 performers in GRNY were Meta, Alphabet, AMD, Goldman Sachs, and BNY Mellon. So financials and tech. The bottom 5 performers were Packaging Corp of America, MicroStrategy, Chevron, 10K, and Texas Pacific Land Corp. And on GRNYJ, top 5 performers were Lumentum, EchoStar, Reddit, Rocket Lab, and Royal Gold. And the bottom 5 performers are Universal Health Services, MP Materials, HF Sinclair, and Next Power. So again, it's energy. So in terms of themes, millennials was the best performing theme, followed by easing financial conditions, and lastly, global labor and AI.
One of the most counterintuitive developments in this environment is asset performance. Traditionally, during geopolitical crises, investors flock to gold, bond, defensive sectors. But this time, the leaderboard looks very different. According to Tom Lee's analysis, crypto, especially Bitcoin and Ethereum, has been the top performing asset class. Energy comes next, benefiting from rising oil prices. Technology stocks follow closely behind. This is a major shift in market behavior. Why is this happening? Because markets today are not just reacting to war, they're reacting to growth expectations and liquidity conditions. When investors worry about slowing global growth, they don't just hide. They rotate into assets with long-term upside potential. That's why growth stocks, especially in tech, continue to attract capital, and this is clearly reflected in individual stock performance.
Let me walk you through some particulars. The large cap granny shots, GRNY, as of April 2nd, had a price of $24.01 and assets of $3.8 billion. GRNYJ, the mid cap granny shots, had a price of $25.39 and assets of $377 million. And GRNYI, the income granny, had a price of $19.05 and total assets of $45 million. Over the past week, GRNY rose 2%, while the S&P rose 3.38%, underperformance of 132 basis points. GRNYJ rose 3.5% compared to a 3.7% rise for the Russell 2500, or 44 basis points of underperformance. And the income granny rose 2% compared to a 3.38% gain for the S&P 500, or 141 basis points of underperformance. Now, on the macro, let me explain why I believe the bottom likely is in. I know we're in the fog of war, but keep in mind, stocks, since there have been 8 major conflicts in the last 125 years, including this Iran war, and stocks bottomed 10% into the duration of the war. Think about that. Only 1/10 into the progress of a war, even before troops are committed, stocks typically bottom. This was true of World War II. The U.S. entered the war on December 8, 1941. The Dow Jones bottomed 5 months into World War II, even though the total war lasted 45 months. We could see it on a time series here. This is when the U.S. entered World War II. The equity markets bottomed 5 months later in May 1942. And June 1942 was the first real battle of Midway. 1 month later, and the Dow was already rallying. The U.S. didn't enter Europe until D-Day, June 1944. That's a full 2 years later. And as you can see, the market went up after the invasion. So knowing this fog of war, let's go back to today. There's 3 reasons I think the stock market bottomed. The first happened because the stock market began to rise while oil rose. The equity markets and oil have had an inverse correlation, and it got to an extreme inverse correlation recently, the highest in a year, meaning as oil went up, equities went down. And we could see the inverse relationship at play since the war started. Whenever oil went up, stocks went down. Conversely, once oil went down, stocks went up, and this continued. But then there was a pivot at the end of March, and that pivot was that oil went up, and yet the S&P rose 5%. And then the second thing happened earlier this week, which is we had less bad news. The ceasefire is not an end to the war, but it's the beginning of the end of the war. And I know it sounds strange, but it's a rate of change observation. When less bad happens, that's considered good. And as you can see, as soon as we got signs that the war was de-escalating, oil fell 20% and the S&P rose. And the third sign arose today, which is the end of on April 9th. And that's because the VIX had closed above 30 and then fell and closed below 20. It's a sign that the idea of seeking risk protection had already peaked. We can see that on this time series. Shortly after the war started, the VIX jumped to 35 and it closed above 30 at the end of March. And then this past week, it closed below 20, the first time since the war started, or it's back to pre-war levels. Since 1990, there have been 4 times where the VIX moved above 30, then oil had a big decline, and then the VIX closed below 20. And here's the thing. The median 6-month return is 9% after closing below 20. That implies the S&P can get to 7,400, which is more than an all-time high. So nobody rings the bell at the bottom, but I believe the bottom is in.
Putting it all together, crypto is leading signaling risk appetite, tech is strong signaling growth expectations, financials are stable signaling resilience, volatility is falling signaling reduced fear, historical patterns suggest early bottoming. This paints a very different picture than the headlines. Instead of a market in collapse, we may be looking at a market in early recovery. And as Tom Lee emphasizes, nobody rings a bell at the bottom. By the time investors feel comfortable again, the market may already be significantly higher.
So last year, in the fourth quarter of 2025, I said that Bitcoin had likely topped out at $126,000 and that we were likely entering into a bear market that would probably last around a year. And what I said is that a realistic view for Bitcoin, not a doomer view, but a realistic view, would be that Bitcoin would drop approximately 70% plus or minus 4 or 5% from the highs. But that after a 50% drop, we would likely stall out there for a while en route to the larger drop. Okay? Now, in my mind, and my mind again is different than other people's, right? But in my mind, calling for a 70% drop, approximately, should not be considered a doomer view. And we will talk about what a doomer view would look like, but in my mind, that should not constitute being a doomer. It would constitute being realistic about price expectations. And one of the reasons why it would make sense to be of the mind that Bitcoin entered into a bear market back then and is likely still in one, even if we do go up a little bit more, is just looking at how similar the cycles really have been. And one of the common things you'll see now is a lot of people say, well, Bitcoin can't go down because everyone thinks it's going to. But I mean, in Q4 of last year, people said the same thing. They said, well, Bitcoin can't top because everyone thinks it's going to. And then it topped anyways. But if you look at the ROI of Bitcoin from the low and just kind of look at the last 3 cycles, they were all effectively the same length within 1 week of each other, as measured from the low to the high. And then if you extend that out to the next low, you can see that it would still put the sort of the market cycle bottom of Bitcoin several months away. I've said it could happen as early as May, but I wouldn't argue that it's my base case. It could become my base case if we get a quick capitulation between now and then, but it's not my base case right now. My base case is it'll happen later on. Now, when you look at Bitcoin's bear markets that it has entered into at the end of prior post-halving years, you can see, and some of them were not, this one was not the end of post-halving year, that was about a 94% drop. The next one in 2014 was about an 87% drop. The next one was about an 84% drop, and then the next one was about a 77% drop. So Bitcoin has already seen drops in the range that we're talking about. And what I'm saying is from the highs, a 65% drop from the highs puts you at around 42,000. A 75% drop would put you at around 31,000 or so. So 31K, something like that. Depends on exactly where you measure it and what exchange you're using. To me, that doesn't seem like that crazy of an idea, but there are a lot of people that would essentially say that that is a doomer view on the market, despite the view just being in line with prior bear markets. Now, there is a valid criticism, and the valid criticism is that if we did not top on euphoria, like all the prior major tops, then why do we have to have a 70% drop? Is it possible that it's just a 50% drop? It is possible, but I would put the odds of the low being in at maybe around 25%. I'm not saying it's impossible. The best evidence for the low being in would be if you compared this bear market to the one in 2019. It's kind of extended. It's had that 50% drop, that 52 to 53% drop, just like it did back then. And then the market started to rally for a little bit. The problem is that while I don't expect a pandemic to occur that would lead to a massive capitulation, I do think that the United States is likely heading towards a recession. I just don't think it's going to be induced by a pandemic, is the difference, right? I don't think the unemployment rate's going to go to 15% overnight, right? But I do think the unemployment rate structurally is going to continue trending higher. And real GDP just came in for Q4 of 2025, and it came in at 0.5%, right? We're already almost negative.
Not everyone agrees on the severity of the current bear market. There's a growing argument that this cycle may be different. Specifically, previous tops were marked by extreme euphoria. This time, the market never reached the same level of hype. So the question becomes, if there was no euphoric blow-off top, do we still need a deep crash? This leads to two competing scenarios. Scenario 1, milder bear market, 50% drop. Bitcoin already corrected 50%. Price stabilizes and consolidates. Market begins gradual recovery. This scenario is supported by comparisons to 2019, where Bitcoin dropped around 50%, then rallied before any major macro shock occurred. Scenario 2, full bear market, 70% drop. Current rally attempts are temporary. A deeper capitulation event still lies ahead. Final bottom forms later than expected. The analyst assigns roughly 25% probability that the bottom is already in, which means 75% probability that further downside remains,